conversation right now. We, of course, had many lower than expected earnings results today. We also had negative durable goods orders out of the United States. Let's find out what our next guest thinks about the state, the true state of the U.S. economy. We are bringing in Peter Schiff. He is the CEO and Chief Global Strategist at Euro Pacific Capital. Peter, always great to speak with you and to get your take. There's so much going on today, I think. I don't think that anybody thought that the growth we'd actually see in the S&P 500 was 0.1% now. Maybe you would and did, but what's your view here?
Well, I think we're coming off of a stimulus-induced high. As the effects of QE wear off, the U.S. economy is returning to recession. And I think the markets are going to be very disappointed with the weakness in the earnings reports that they're going to see, in a sharp weakness in the U.S. economy, which I think is going to lead to a lot of layoffs. I think a lot of companies that hired U.S. workers or who are reluctant to lay them off in the third and fourth quarters of 2014, when they really get a true look at the economy and their earnings, I think you're going to see a lot of layoffs, which means the unemployment numbers are going to pick up. Forget about a rate hike by the Fed. In fact, I think the Bank of Canada, which made a mistake, and I think they're going to regret their last rate cut, they're probably going to be raising interest rates before the Fed on a pickup in Canadian inflation.
Peter, that seems so far from possible right now. Why do you think that the Bank of Canada, given the trajectory that they're going down, the trend that they've established, breaking away from trends of the past, would actually be ahead of the Fed for raising rates?
Yeah. I think that the New York weathermen are going to make, or rather the Canadian Central Bank is going to make our weathermen look good. They thought this was going to be a big storm. I think the Bank of Canada overreacted to a slight downtick in inflation. They panicked with that rate cut. First of all, I think the reduction in oil prices is temporary. I think you're going to see a move back up in oil prices later in the year. So I also think, though, that any reduction in, employment activity that might surround the energy sector could be made up for in the mining sector. Gold prices right now are above 1,600 Canadian dollars. I think before the end of the year, they're going to rise above 1,800, which would be a new record high for the price of gold in Canadian dollars. And I think that's going to usher in a Canadian gold rush. And so if anybody loses their job in the energy sector, they can get a job in the mining sector. The United States doesn't have that gold industry really to fall back on. We still produce a lot of gold here, but our production has been declining, and it's a very small part of our economy. Not so in Canada.
Peter, that's a pretty big statement to say we might have another gold rush here in Canada. I'm wondering, what would the driver of that be? Is it just the fact that the gold price has been low for so long, or is it going to be driven by fear and central banks continuing to stimulate their various economies?
Well, first of all, it's not low. I just said we're over 1,600 Canadian dollars an ounce. That's 200 Canadian dollars from an all-time record high. So gold prices are pretty high. I think they're going to make a new record high this year. Meanwhile, oil prices have come down. That helps bring up the profitability of mining because energy is a big part of the cost structure. So I think the profits are going to drive the gold rush, and I think, it's going to happen this year. And I don't think gold prices are just going to go up in Canadian dollars. I think they're going to go up in all currencies, including the U.S. dollar. All these central banks are too loose. The Bank of Canada is too loose. The Fed is too loose. The ECB now, they just launched QE program, which is going to fail miserably. Again, the only thing QE is going to do is drive up consumer prices. It's not going to drive up economic growth or employment, except maybe for older people who unfortunately have to come out of retirement to afford the higher price of food. But all this cheap money all around the world is going to lead a rush into gold everywhere. But Canada is in a good position to benefit. And I also think when the U.S. dollar turns, and it will turn when the Fed doesn't raise rates but launches QE4, that's going to be very bullish for oil prices. They're going to go back up, so that will help out the Canadian energy sector.
Peter, let's talk about that. What do you think is actually on the minds of the Fed today? Given the poor earnings, we of course know that they're not equity strategists per se, but they are obviously looking for a read on the U.S. economy. What do you think they're thinking? They've got their two-day policy meeting starting today. They'll come out with their statement tomorrow. Expectations are that they will raise rates in 2015. What's going through their minds?
Well, I don't think they ever intended to raise rates, but they couldn't come out and say that, so they had a bluff. And I think they're waiting for the right time to announce that they're not going to do it or postpone it. But they want to act like it was a last-minute decision, that it was unexpected, based on circumstances beyond their control. They can't admit the truth, that they have the economy so addicted to cheap money that if they take away even a little bit of it, we go into a complete economic withdrawal. So I think they've been biding their time. And I think that the Federal Reserve they can't be this incompetent as to actually have believed the things they were saying. I mean, I hope that's not the case. I hope they were just lying because they're afraid to tell the truth because they don't believe the markets can handle it. So they're trying to finesse this thing. But ultimately, they are going to do QE4. They're going to come up with some excuse, and it doesn't matter what it is. It might as well be that the sky is blue because they're going to come up with an excuse because they can't not come back with quantitative easing because that's the only thing that's keeping the phony economy going. That's the only thing keeping the stock market up, the real estate market up. It's the only thing keeping the government from having to declare bankruptcy is the fact that the central banks are there. But it's the Fed action that's preventing a real recovery. It's why the problems on Main Street keeps getting worse because the Fed is diverting all the resources that we need to build the real recovery, and they're diverting them to postpone this financial phony recovery.
Peter, let me ask you this one last question, though. You did say that you think that the U.S. dollar will decline or ultimately reverse the trend that it's been on. It sounds like that's going to be based on what the Fed will do, or in this case will not do. They won't be raising rates. But as we look at the earnings and the reports today, all of these company managements are citing the stronger U.S. dollar as a reason for the weakness that they're seeing. Do you believe that? Do you think that there is greater weakness and they're using the strength, the U.S. dollar strength, as an excuse here?
Well, I think a lot of companies are going to use that as an excuse, but to some extent, in the very short run, it's legitimate in that if you have multinational earnings and they were coming into these other currencies, you haven't had a chance to maybe change your pricing structure. It is going to be part of the reason that the earnings are going to be disappointing, and a lot of the companies are going to end up trying to cut costs to make up for the lost earnings, and I think that's going to come in the form of layoffs. But ultimately, I think people have this trade wrong. Everybody is piled long the dollar. I think people are going to lose a lot of money betting on the dollar, just like people lost a lot of money betting against the Swiss franc. They thought they were making money for a while, and then they lost all their profits in a spectacular, decline. I think that this is the trade you want to fade. The dollar rally is all based on the false expectation of a U.S. recovery and a tighter Fed. Nobody is expecting renewed recession in QE4, but that's exactly what's going to happen.
Peter, great to speak with you and get your thoughts. Certainly contrarian versus the consensus that's out there right now. Peter, thanks so much.
You're welcome.
That was Peter Schiff. He's the CEO and Chief Global Strategist at Euro Pacific Capital. We'll come